Stakeholder.
In gambling, an independent party with whom each of those who make a wager deposits the money or counters wager.
A person with an interest or concern in something, especially a business.
In emergency management, any person or entity with a vested interest in the survival and recovery of a given community. You.
Welcome to Stakeholder Prepping.
Welcome back to Stakeholder Prepping, where you are the stakeholder in your own survival. We are your hosts. My name is Chris.
And I'm AC. And today, we're going to go over one of the most important yet most forgotten preps you can have. I'm lucky enough to have, for some reason, a ton of friends and family in my life that work in this industry. So I'm definitely a little bit more dialed into this than most people. But Chris, you yourself, you are a pro. You are in the industry. And in my opinion, this is the ultimate prep. This is step one of prepping, really.
I would agree. This is probably one of the most underrated preps that we all have and don't really think about it as one. Today, we are talking about your insurance policy, not gear or skill set or some specific disaster and what you can do to prepare for it. We are quite literally talking about the insurance policy that you have on your home.
You know, I would almost disagree that we're not talking about gear in this one because, you know, we all know that preppers, we are hoarders. And like we talked about in the Joe Flowers episode, there's kind of that three sides to the prepper triangle. There's skill, there's knowledge, and there is gear. And insurance, it covers your gear. So, you know, before you just tune this one out and write this episode off, honestly, give it a chance. It may not save your life, but it will certainly save your gear. It'll save you headache, and it'll save you from having to start back at square one entirely. And this isn't even really much of a prepper episode. I think we're going to relate this to prepping, but this is kind of like a life episode. Like this is for everybody. Anybody could listen to this episode and get something from it. Not just people like our listeners who are just prepared for shit.
Chris and AC, life coaches extraordinaire.
Hey, if this podcast thing doesn't pan out, man, I say we go into the life coach model. We'll see.
It is really critically important for getting back on your feet after a disaster because regardless of the type of disaster, we're going to go over the most basic type of policies in this episode, the different types of coverages in them, and some major gaps that are often left out so you know what questions to ask your agent the next time you actually sit down and talk to them, which I'm guessing for 99% of our audience is you'd set up the policy and haven't talked to them since.
Yeah, it's never.
And we're going to try to break this down and simplify it just so that you don't have to learn the legalese language and really memorize your contract.
Yeah, and what you said right there is super important. It is a contract. Your insurance policy is a contract, specifically a contract of adhesion, meaning that you pay for this specific thing and your insurance company agrees to pay you for those specific things. I think a lot of people, they think about insurance differently. Like they think that if they just pay their insurance premiums forever, then anything that ever happens ever will just always be covered and they will be made whole. And that is just not how it works, right?
It's not really how it works.
It's not how it works. So before we get into that, we're going to make a couple of assumptions with this episode. One, we are going to assume that you have a domicile, whether it's an apartment or a condo or a house or a trailer. You probably do live somewhere. And two, you have insurance on that domicile. So if you live in an apartment right now and you don't have renter's insurance, stop. Just stop the fucking episode, hit pause, don't listen to it yet, and go shell out like the $10 a month to insure your stuff. Like,
I could not agree with that statement more because, oh my God.
Dude, it's so important. It's so cheap. Renter's insurance is so cheap. If you don't have it, just go get it now and then come back and push play again. But like I said, I'm lucky enough to have family and friends that work in all aspects of insurance, from claims to underwriting. Some even have college degrees in insurance. And I myself, I actually read my policy, so that kind of makes me a pro. But Chris, you're actually a pro here. This is your life, right?
It is. And, my wife and I, we have our home and we have a mortgage, and that mortgage requires that we carry insurance. But that does not make me a professional. What makes me a professional is I have several years of experience as a licensed insurance agent. I actually have my personal lines coverage specialist, the PLCS designation, so I can add those little letters onto my
Ooh,
signature block,
letters on your name.
yeah, like ESQ for Esquire or whatnot.
Yeah.
And I do actively work in the industry for a Fortune 200 company. And even though my primary role right now, I coach and train others on how to handle underwriting situations and contracts and billing and specialty programs and the like across 8 different carriers, I do still answer the phones and talk to customers to build policies that meet their needs, their budget, their future plans. So I do actively talk to people and get to have these conversations over the phone and help people. And that's one of the reasons I find it super fulfilling.
Yeah, so you're not just you're more on the contract building side of things. You're not the guy that goes out to inspect for damage after a storm and says, "Yep, that roof is going to cost you 30 grand." So that makes sense. So, all right, take us to insurance school for preppers. Where do we start exactly?
So we're going to focus primarily on property insurance rather than auto insurance. Auto gets really wild when you start throwing in state minimums and take all comer states and stuff like that. But we can really simplify the basics of property insurance regardless of where you live. Okay. The place to start is really understanding what insurance does. When you have a property insurance contract, the basic idea is that you pay a premium for protection from what can happen, i.e., a claim. The idea that your policy will pay the money to bring you back to where you were the day before the claim happened and brings you right back to square one as if that event never occurred at all. And this is why it's so important to keep your policy up to date because things do change. The price of 2x4s, I mean, we all saw it. It skyrocketed during the pandemic. Home Depot and Lowe's had to be raking in millions over what they were
Ugh,
expected to.
yeah.
And the price of other building materials went up as well. And even if you shop at Walmart exclusively for your clothes, it's still $50 for a pair of jeans nowadays. And it just seems to keep going up and up and up. So if you don't have enough coverage on your policy to get you back to square one, you already have a gap that isn't covered and you have to pay out of pocket to get back to where you were. So this is what's called indemnity. And indemnity is what is provided for you under your contract. So you want to make sure that you have enough contract coverage to replace what is lost.
Okay, so that makes sense. And for anybody that isn't sleeping yet, this gets better. But let's be honest. We all know it isn't about what can happen, but it's about what will happen on a long enough timeline, right? Just because you live someplace that doesn't get hailstorms frequently doesn't mean you will never have to file a claim for a hailstorm. Eventually, they will show up. You will eventually get a thunderstorm that gives you, the need for a new roof. It really is Murphy's law. And Chris, I know you're probably going to go into all these different kind of policies, but there's basically three. There's three basic top-down homeowners type policies. And, regardless of whether we're talking about renters or homeowners or whatever. So, first thing to know is what your policy says. If you have what they call an all risk less exclusion policy, basically everything is covered except the stuff they say isn't covered. And then there's this named peril policy, meaning that basically nothing is covered except the stuff they say is covered. And the third is it's a modified open peril, and that one is a bit tricky. So, Chris, you'll have to take that one. That's the one I don't really know about.
Yeah, sure. So that's basically an all risk less exclusion, but then there are some extensions of coverage in certain situations. And it's the hardest to understand and the hardest to read. So an example might be water damages are excluded unless it's caused by a unicorn pissing on your carpet on a Tuesday. Then that could be an extension for coverage,
Got it.
right?
So, if there's rainbow or glitter in the pee, then it would be covered.
Exactly.
Got it.
Ideally, this would be anything that can or will happen to your home. There are some general exceptions and some specific ones, and we'll go into those later. But the the big three types of contracts that all risk less exclusion, the named peril, and then the modified open peril. The named peril is the least amount of coverage, and all risk less exclusion is going to be your most amount of coverage.
Got it. Okay. So I pay my premiums, and if nothing happens and I don't file a claim, then what? Is my money just kind of wasted?
It really may feel like it, but it's not. So there are 8 major types of insurance organizations, but basically for this exercise, your premiums, along with every other person who has that company, it goes into a big pool. Think of a swimming pool.
Hmm.
Okay. Everyone pays their premiums and they go into that pool. And when you need to file a claim, you take your ladle and scoop out the water out of that pool. You take the money that you need out of that pool. But so does everyone else. So if there's a massive storm or a fire or something where everybody has to pull out their claims ladle, that pool gets significantly smaller and shrinks. And some people will have bigger ladles, some will have smaller ladles, ones that the whole house and everything that fits inside of it has to be covered. So your ladle size is determined by your claim. And ideally, the pool that everyone pays into is large enough to service all of those total loss claims without running out of water.
Okay, so that makes sense. Everybody pitches in, and then when someone needs help, they take what they need from that resource pool. This is pretty much how communal prepping is defined, right? Like when someone needs help, you help them, and they pitch in their fair share as well. And that's why, you know, when there are more claims, your premiums just go up. The payment you have to make to the insurance company does go up. So I do want to sidebar here real quick and say, like, I don't want to give anybody information on how to help them like scam their insurance company. And I'm using quotation fingers right now. You know, their insurance company is there to actually help them, and they do have this contract. And I don't want to help anybody make a claim unnecessarily, because that's going to make my insurance premiums go up, right? Like if you scam your insurance company or they pay you too much money, that's why I end up paying more, right?
Yes, and it also falls under the term insurance fraud,
Oh
which in a
yeah.
lot of areas, in most areas, is a felony.
Ooh,
So there goes your clean record for
sure.
insurance scams. So
And I want to buy more guns, so let's not scam insurance.
yeah, it's hard to pass that background check as an insurance scam felon. So
Mhm.
don't do it. It's not worth it in the
But
long
the
run.
word fraudster sounds cool.
it
I don't know, like
it is
just
kind of a neat word,
it is a
but
neat word.
until it's attached to your name,
Right, exactly. I'd like to hear about other people being insurance fraudsters. So, anyway, yeah, that's a
that
good way to look at it, right?
it is. And let's take a look at the most common types of property policies, right? Now, there
Mhm.
are a ton of different types of specialty contracts that you can get into. So, historic homes, custom builds, non traditional materials, things like that. But for this, we're going to focus on the four most common types: renter policies, condo policies, homeowner policies, and rental property policies. And in all of my experience of doing insurance, these are the four most common types that I see on kind of a day to day basis. And there are a lot of commonalities between them when it comes to coverages, but let's just take a look at kind of the high level basics, because you can always call your agent if you want more information.
Right. So, let's start super basic. Here's just your total basic bitch policies. Hit me with it.
So, starting out, you have your renter policy, which is called an HO4. This is the one where you live in an apartment, you do not own the home. And this is applicable whether you pay rent or not. So, even if grandma owns the home, you don't have to pay rent, you still have to cover your stuff. So, this is the most basic: cover my stuff and my stuff only. You aren't worried about rebuilding the house because it isn't yours to rebuild. It belongs to your landlord, and that is their responsibility. They would have a rental property policy, commonly called a DP3 policy, and that covers the house itself, but none of your stuff. right? So
Okay.
renter policies tend to be the least expensive because there's no structure to cover. And DP3 or rental property policies, they can be cheaper than a normal homeowner policy because there's no stuff to cover. Does that make sense?
Right. So really, you just have these two policies owned by two different people at the same location, but they cover different things, and they kind of have to work in concert if something happens. That makes sense to me. So your policy may be covering your stuff inside the dwelling, while this other policy that your landlord has covers like the the appliances and the walls.
You got it.
Okay.
So next up is the condo, or what's called an HO6 policy, which by its simplest definition covers everything from the walls in on a condo. But this does kind of vary by state. The condo association, what are called CC&Rs, which are your covenants and restrictions. Sometimes it's paint in, sometimes it's studs in, but basically the inside is yours and the outside isn't. And the outside of the building is not insured by you. So exterior damage, lightning strike to the roof, or somebody drives into the lobby of your building, as examples, that damage is covered by the condo association master policy. And your policy covers the floors, cabinets, personal belongings, everything on the interior of a unit. And you can have rental property policies for condos where it covers everything except belongings, but we're trying to keep this simple.
Okay, so let me pause you here for a second. If I have a condo policy, if the roof is damaged from a storm, then that goes to this master policy that isn't mine. But if my ceiling is damaged because the roof storm damage comes through and messes with my ceiling, then I file a claim for that because I own that paint, right?
For the most part, exactly right.
Okay.
And again, it can vary by policy and specifically what the association says, but yes, that is a broad generalization. If the neighbor upstairs lets their tub overflow and it damages your ceiling, you have the ability to file a claim. If it happens to the outside of the building, if somebody runs over the entry sign, that falls on the master policy for the association. And there are obviously some custom policies out there that have limitations, but by and large, you have it correct. Anything on the interior, that is your condo policy, but damage to the exterior building, that's the master policy, which is not owned by you. Cool?
Yeah, that makes perfect sense.
So let's look at the most common one I see, which is the HO3 or the homeowner policy. This one, you own the house, you own everything inside, you generally own the land. This is kind of the gold standard of what most people think about when they hear the term homeowner policy.
Yeah, this is what you would get like if you're trying to purchase a new house and the realtor says, "Hey, the mortgage company wants proof of insurance before you can close and get your keys. So, call an agent or I've got a list of agents you can work with, right? This is the homeowner's policy. You own it all."
Precisely. Now, this one, we are actually going to break down the coverages so you know what all goes into it. And with each of these, remember that this is not the only contract type that these coverages are listed on, but it covers the majority of available coverages. And this is where it's going to get kind of fun because we're going to go into this. I'm going to go through all of these coverages the same way that I was taught on how to remember them. So,
Okay.
starting out, we have coverage A, right?
Hmm.
Don't do this one if you're driving, but if you keep your hands flat, touch your fingertips together, and then touch your thumbs together, you get this triangle and you get the letter A. And it looks like a house. So coverage A is the amount you would get to rebuild the actual house. Everything from the foundation to the walls, the drywall to the lighting, the windows, the doors, the roof. If you had a complete and total loss, that coverage A amount is what is needed for demolition, debris removal, dumpster fees, architect fees, new materials, the crew to put it all back together. Coverage A is the total cost your company estimates that it would take to put Humpty Dumpty back together from the ground up. And this is important because as the price of materials and labor and everything else keeps going up and up and up, You may want to talk with your agent about refreshing that number because it may not actually be enough to rebuild. What was good 10 years ago doesn't necessarily hold as good today.
Yeah, and when we talk about that coverage A, let's say for round numbers, let's say you bought your home for $1 million, but that coverage A, it's not going to be for $1 million because that price is that what you paid for the home is like what all of it's worth. Your land, the dirt, the location, the location, the location, as my realtor keeps saying, right? So that coverage A, it might only be $100,000 because that's what your house is worth, the actual stick built structure on there, right?
Yeah, and that's exactly how you get 1,200 square foot condos that cost $3.4 million on Miami Beach because they are so prime location that the reconstruction cost on the inside of that condo might only be
Right.
120,000.
Right. That's a really good one. Yeah, that makes sense. So, all right, you talked about like, making sure you actually have enough in that coverage to rebuild. So, this is one of those things to do with when your policy comes for renewal. This is a prepper move. This is just like cycling out your fuel or your food or your water storage. This is one of those annual things you do. You got to cycle out the policy, right? And make sure it still fits.
That's a really good way to look at it and something that should be added to your calendar. As soon as you get your policy renewal packet, look it over, do the estimates yourself in your head, and then talk with your agent if you need to increase your coverage. But let's look at some of the other basic coverages.
Okay.
So, coverage B, the stuff out back. B is for backyard. This is your other structures coverage. So, your shed, fence, driveway, sidewalk, mailbox, really anything that is on the property that is not directly connected to the main house itself. Usually, when you set up your policy, your agent is going to kind of default that amount of coverage to a percentage of your coverage A, again, your rebuild amount. So if you have 300,000 in coverage for the main home and 2% coverage B, then you have 6 grand to replace all of your other structures. And in some cases, that may not be enough. So be sure to pay attention to what your actual coverage amounts are and talk to your agent if you need help updating them.
Yeah, I can see how this would go unnoticed for a lot of people, but would be super important for a lot of homesteaders who have a lot of things like, say, pole barns on their property that just aren't covered correctly. And this is one that's kind of personal to me because I have like a weird tiny structure fetish on my property for some reason. It's just like littered with chicken coops and shooting rests and she sheds and pump houses and greenhouses and snipers' nests and things like that. So the insurance company I use, their default is 10% of coverage A. So my coverage B is 10%. And that is just not going to cover all of these dumb little tiny structures if I had like a total loss, especially because I have like a big outbuilding too. So I called my agent and I upped that coverage from 10% to 50% because a total loss, I would be totally screwed. Like that 10% coverage, let's just say for rough numbers, it might be like 30 grand. That wouldn't that wouldn't cover that wouldn't even cover just my pump house itself. And so, I upped that to 50%. And I'll give you just some rough numbers here. That was an extra, I want to say like $150,000 in coverage. And it cost me about $10 a month.
I was going to say that's right at the $120, $150
It-
per year in
It's
most
ch-
cases.
It's literally cheap insurance.
And that's a very good point. A lot of people don't realize how much coverage they have or what that coverage actually entails, right? So
hmm
let's move on to coverage C. C is for your crap. This is all of your personal belongings minus your car because your car is on its auto policy.
So C isn't car. C's crap. C is
C
not
is your
car.
crap.
C is crap.
So if you could take your house and turn it upside down and shake,
hmm
all of the stuff that comes out is your coverage C. The
Got it.
clothes, the shoes, the DVD collection, the TV, the pots, pans, the bed, the mattress, all the way down to your favorite toothbrush. That's how I describe it to the customers that I'm speaking to. So if it is not nailed, glued, or screwed down, then it is generally going to fall under your personal belongings coverage C. A lot of the time, this will also be a percentage of your coverage A. And a lot of policies I see are at 25, 40, 50, or 75% of the value of the home. So, if you want to be able to replace all of your stuff if something happens, all of the stuff that you have gotten from Grim Workshop using our discount code, or Shomertech, or all of the MyTopo maps that you have collected, if you want to make sure you have enough coverage to rebuy everything brand new. And let's clarify here, there are specific coverages, often called riders or endorsements, scheduled items, whatever your insurance company calls them, but this might include firearms. There's specific coverages for firearms and jewelry and artwork and boats and trailers. And it's what in the industry it's called specialty items. A lot of the time they are what's called scheduled or listed out separately because your coverage may not be adequate on those things using your default policy. So
Yeah, so like if let's say I've got, $100,000 in coverage C and I'm like, "Oh, I'm good. All my guns are covered." But in real life, my policies say that only covers $1,000 worth of guns or something. I would want to call my insurance agent and be like, "Hey man, listen, I need extra coverage on these specialty items because even though I have a ton of coverage for my crap, it doesn't cover some of this very specific crap. You need some kind of endorsement for this specialty item, right?"
Right. So all of the 30 carbine that you've got, it
Yeah.
might only cover the ammo cost on
Oh
the default
man.
policy.
Yep.
And all of the guns, it may not be enough to replace all of the 30 carbines that you've got, all 420 or
That's a
whatever you
problem.
have of
I
them.
know. Yeah, it's a bunch. Yeah. Okay.
There is one very important topic that I want to bring up here because it applies to both your other structures and your personal belongings. It can apply to your main home coverage. Okay.
Okay.
There are generally two types of coverage when it comes to the settlement of a claim, which is the amount you get paid if something happens. There's replacement cost coverage and there is actual cash value.
Okay.
Generally, RCC or RCV, how it's listed on some policies,
Hmm.
means that if you need something to be replaced, you get the money to replace it new. So if you had an 80-inch flat screen that got stolen, you get the money for a new 80-inch flat screen. If you need a new roof, you get the money for a new roof. Actual cash value means that the money you get to replace things depreciates over time, meaning that your policy will only pay 80% of the cost for a new roof because it's, 5 years old,
Okay.
or however your insurance company works out the schedule for all of that. Good rule of thumb is if you have ACV for the roof, you can expect 2% less for every year older that your roof is.
And that's because the roof is a 50-year roof, so 2% times 50 is 100%. Is that kind of how you're getting there? Or ish?
More or less. Some companies, it'll drop as much as 5% the first year. Some
Oh, okay, that makes
companies,
sense.
it doesn't drop until the roof is 3 or 4 years old. So
Okay.
it really kind of depends on how they schedule it out.
Okay, sure.
But with those schedules, a lot of the time, coverage B and coverage C, so the backyard and your crap, by default, they get left as actual cash value coverage. So even if your shed burns down with all of your lawn tools in it, you might only get half the amount to truly replace them if you have ACV coverage.
Even though to me they're just as good as they are new. Like a shovel, although it's old, it's still just as good as a brand new shovel.
And you shouldn't have to get a new shovel, but they don't
Right.
sell used shovels at Home Depot or Lowe's.
You have to go to the used shovel store. Yeah.
Yeah. And
Yeah.
I have not seen one of those
I haven't
in
either.
ever.
Yeah.
But
Okay, that makes sense.
but sometimes you really have to look at your coverage, and if you have any doubts about the type of coverage that you have or can't find it in your contract, call your agent, have them define it for you very clearly. Sometimes the home itself will have replacement cost coverage for the house except for the roof, and the roof itself is actual cash value. Some companies have requirements like the age of the roof has to be below a certain level before they will update the contract from actual cash value to replacement cost. So if you want the replacement cost, you have to get a new roof before they consider it. The big point here is know what kind of coverage you have for each section of your policy before something happens, so you're not blindsided by it when it comes time to make a claim.
Okay, yeah, that makes perfect sense. So there's a bunch of different combinations you could potentially have with this. And the only way to know for sure is to read the contract you bought. And I just can't say that enough. Or, yeah, you can call your agent about your policy. And I'm sure that there are some companies with online portals that, you can just go online and look at it. But not all of them spell it out exactly kind of what coverage you have. And it's kind of hard to understand. But honestly, just you got to read. You purchased a contract, right? You purchased a contract of adhesion, meaning they promised to do a thing for you. Just read the contract.
That is 10,000% accurate. And I know reading through your contract is like digital Ambien because it will put you right to sleep.
So boring.
It is super, super boring, but it is one of the most valuable prepping tools you can have.
It absolutely is.
And you're right. Some companies on their online portal, they give you flyouts on what's covered and how the coverage applies. But a lot of them want you to actually call the agent so they can make the changes for you so they can prevent underwriting errors, because that underwriting errors tend to drive up your premium because they have to then correct them, and that costs man hours, that costs money.
Mm-hmm.
Right?
Yep.
So the next coverages are D, E, and F. Coverage D is for the hotel.
Yeah, the hotel.
The hotel.
Got it.
That is your loss of use coverage. Okay. So say you have a kitchen fire and you can't stay in the home while repairs are being made. It's not safe, or the construction crew that's fixing it is just taking up too much space. Your loss of use is designed to pay for hotel, the increased cost of gas to get back and forth to work because you're further away from your office, the increased cost of eating out because you can't use your own kitchen. Even pet boarding is covered in a lot of cases. Most of the time, it will either have a dollar limit or a time limit or both. So you have up to $10,000 or 2 years, whichever comes first. My advice here is keep the damn receipts. If you have to use this coverage, because a lot of the time the adjuster will just make broad assumptions, keep the receipts so you don't have to lose out on money out of pocket.
Yeah, and that loss of use, that's also called ALE, or additional living expenses. On my policy, it's called ALE. So yes, keep the receipts, you have proof, and that makes sense. Oh, and I can tell you that ALE, that loss of use, it is never enough. Like, let's say on a renter's policy, you probably have, I don't know, I've seen like my renter's policy, when I had an apartment, it was $5,000. That seems like a lot of money. But let's say your apartment building burns down and it takes them 6 months or a year to rebuild that thing. They're just going to give you $5,000 to live somewhere else, probably in a hotel for a little bit. And then that has to cover all the extra food that you're going to have to buy because you have to eat out now because you don't have a kitchen, all those kinds of things. So ALE, it's that additional living expense is never enough. So know what that is. Some places may have like a per diem or a flat amount, like you said, but it's never enough if you have a total loss. And people can get creative here. There are people that maybe they'll move into their own camper or RV for a while and then take the money from their insurance company. And you could actually live for a while because you like already have another domicile. But if you think that you're going to get that loss of use after you have a total loss, like your house burns down, and then that money is going to carry you through for a year that it takes you to get the permits and rebuild your home, it probably isn't. Be aware of what that loss of use or additional living expense line item is in your policy.
And you might be lucky enough to have a company that has unlimited loss of use for a time frame.
Okay.
A lot of companies are going to have that dollar limit or the time limit or both.
Mm-hmm.
But every once in a while, you will come across a contract with certain companies that it's, 2 years, unlimited loss of use. The way they justify that is equivalent living. So they're not going to pay for you to go stay at the Ritz-Carlton Hotel, Miami Beach.
Yep.
But they will pay for your average hotel, maybe it's the Hilton down the street, they'll pay for that, but they won't pay for the super extravagant one. But they're going to give you more than, staying at the Motel 6 for
Right.
2 years.
So they'll give you a 2-bedroom hotel with a kitchen and kind of say, yep, this is sort of like kind quality for what you had. So anyway, yeah, there were the last two. Is it E and F, I think?
Yes. So E and F are your liability and medical payments coverages. On your policy, these may also be marked as L and M coverages, depending on your insurance company. I don't see that often, but it does happen. Your liability is your lawsuit protection. L, liability, lawsuit. Someone comes over for a barbecue and they cut their finger using your knives, or they trip on the sidewalk and they skin their knee, snag an elbow on a nail in a door frame. One of the wildest claims I think I've ever seen, I've got two here. One was a 13-year-old that was practicing in marching band with trombone and stopped short of their position, and the person behind them ran into them and broke out like 7 or 8 teeth.
Oh, wow.
And that was a liability claim. It can come from 8-year-old girls soccer. I've also seen that. But the wildest one I think I've ever seen out that was legitimately paid out is a woman who got drunk at a wedding. She fell over, and through this really odd set of circumstances and placement, she cut the bride with a broken champagne glass across her neck. And
Oh my gosh, you're
that was
kidding.
a major liability claim,
Wow, that's crazy.
right? But all of these are very possible liability claims, and that is far from a comprehensive list. In today's society, you can get sued for just about anything at any time by anyone. So you want to make sure that you have enough liability coverage to protect your assets. Cash, your nest egg, the home, the cars. You don't want to short yourself on the coverage and end up giving your prized 93 Jeep Wrangler Sahara Edition to some asshole because your dog barked at him wrong.
Was that a Jurassic Park reference in the insurance episode?
Gennaro's entire job in Jurassic Park was to inspect the liability assumptions of the park in case of accident, which spawned the entire long weekend tour with Dr. Grant, Dr. Sattler, and Ian Malcolm. If it weren't for insurance and liability concerns, we never would have gotten one of the greatest treasures in film and literary history. So you better believe that was a nod to Jurassic Park in the insurance episode.
Every day is a school day. I love it. That's amazing.
So finally, we come to our coverage F, which is your medical payments to others, right? This is the good faith, don't sue me payment. It's designed to pay for cuts, scrapes, burns, stitches, dental work, ambulance ride. It really is the I'm sorry you got hurt on my property. Let me at least cover the medical bills portion of your policy. And a lot of companies will max this out at $1,000, $2,000, or $5,000 because they are operating under the assumption that the person who got hurt has health insurance and you are simply covering their major medical deductible for the year. But $1,000 may not cover all of that, so the injured person may come after the liability part of your policy for the remainder. E and F, your liability and your medical payments, they kind of work together, but they don't always have to.
Yeah, that makes sense. And I think there's some stuff I've heard, there's weird things like if someone's there for like work, like if it's the UPS guy or your gardener, they're not covered under one sometimes, or like they have to be invited. So like a robber can't just like say, hey man, I stubbed my toe, I was robbing you. Can I get $1,000 for my deductible? Right? Like there's some weird stuff there.
So much of that comes down to state law. There have been stories of a guy who broke into a house and fell onto the kitchen counter and cut his back on the kitchen knives and sued the homeowner and won, even though he was in the process of breaking in to rob them blind while
I
they were on
have heard of
vacation.
that. The on liability, like your liability is open for anything. Like there are people like, yeah, a robber could actually sue your homeowner's policy. But that's kind of why that exists, because then you're not going to lose your home. That's why you have liability coverage, right? So let me let me backtrack and go over coverages real quick. This is, and for anybody that's still awake, it even gets better, trust me. But so A is the house. That's the shape I make with my hands. B, that's the backyard. C is your crap. D is the duh hotel. And E is liability. F is medical payments. But those both kind of work together. So all of these can kind of be set up for however you want them to be set up. Like you can have any of those coverages, any amount if you pay for it. Is that right?
Usually, no. So, your company will build almost all of these coverages in relation to the reconstruction cost of the home. So, as an example, if your home would cost $300,000 to rebuild from the ground up, that's what they're going to base it on. You might be able to go a little bit higher in coverage on it if your company allows it, but you likely will not find a company that will let you have $1 million policy for coverage A on a $300,000 rebuild.
Okay.
Liability can easily go to $1 million. And usually it isn't that much more expensive. It's only $12, $13 more per year. But your primary numbers are always going to be based on the reconstruction cost of the home.
Okay, got it. Yeah, that makes sense. So what are some of the dangers of a policy? We've heard all of these kind of horror stories and that these canceled policies in California because the wildfires, things like that. But what are some of the things that people should look out for?
I'm really glad you asked that way because it is important, and possibly the single most important section of your entire policy is going to be titled Losses We Do Not Cover. This is critical because it outlines the things that you are not covered for under the contract. In some areas of the country, this may be wildfires. Other places might not cover wind, hail, or hurricane. Other places still might not cover earthquakes or sinkholes or what's called ground subsidence or mine subsidence activity. And there might be something that you need to add on, like flood coverage. So most homeowners policies, regardless of the company, will not include flood coverage by default. So it's important to understand what you are and are not covered for. Things like intentional damage. I mean, if you decide to go play Tiger Woods in your living room, the golf balls in the drywall, that's not going to be covered because it's considered intentional damage.
Okay, that makes sense. So you're saying that like water damage isn't covered under my homeowner's policy because you just mentioned like a flood wasn't covered.
Well, and there's a big difference between water damage and flood. Think of it this way. So, water damage is inside water trying to get out, like a broken pipe,
Mm-hmm.
right? Flood is outside water trying to get in. And FEMA defines a flood as groundwater covering more than 2 acres and affecting 2 or more properties. So if that is a concern, if you're 3 feet away from a creek in your backyard, like we are, if that's a concern, definitely call your agent about getting a flood policy. And after Hurricanes Helene and Milton, the gap in coverage for flood coverage is very evident with all of the homes that were totaled and had zero coverage for flood. That also includes storm surge, because once the water hits the ground, it's considered groundwater, even if it's coming from a tidal wave. And your policy may have restrictions on water damage depending on age of the pipes, pipe material, things like that. So it's important to check those exclusions in that we do not cover section of the policy very thoroughly to find out if you're missing a particular coverage.
To go in there and just know immediately what kind of things are and aren't covered. Okay, so that makes sense. Now, let's say you do have to file a claim, and this is the important stuff. This is why you stayed awake for this episode. This is why you just sat through this boring ass episode, because let's talk about what are the mistakes people make when filing a claim and some of the I guess the common misconceptions about their insurance policy. I think this is super important. The first thing that comes to mind for me, honestly, is being too helpful. And I know that sounds silly, but if you don't know exactly what happened, just report the facts. Don't speculate. If you're not a plumber, don't share your non-plumber opinion on where the fucking water came from. Like the insurance adjuster, they have a duty to confirm what they call proximate cause and origin of your loss. So they can't, the insurance adjuster has an investigation to do. They have a duty to investigate what happened and then tell you whether it's covered or not based on what happened. You can't, the insurance adjuster can't come over and go, you know what, I don't know what happened, but I'm not going to give you money. They actually have to determine what the cause and origin of your loss was. They have to do an actual investigation.
That's what
And
they get paid for. So
that's
let
what they
them do
get.
their job.
That's right. Let them do their job. And so I have a story. A friend of mine called. Actually, he wanted help with his insurance policy. He had a water loss. He had a flood in his basement. So right off the top, you go, oh, flood in your basement, probably not covered. And he was going to call the insurance company and say, hey, I don't know if this is covered or not, but I've got a flood in my basement because my sump pump failed. And so right off the top, you go, okay, well, that probably sounds like something that's probably not covered. But we got to talking about it. And what happened was a tree in a windstorm fell on his house and knocked the electricity out. It took the breaker box off the side of his house. And then when the batteries eventually died in his sump pump, then the basement filled with water and it ruined his hot water heater and a bunch of the appliances down there, all kinds of shit. But the proximate cause was wind, and wind is covered. And think of it like dominoes falling, that everything that happened downrange of that wind event was actually covered, even though the flood and the water would not have been covered and is not covered in his policy. The proximate cause of that was wind. And so everything downrange of that wind event was actually covered, and he got it all covered. He got everything replaced, which was awesome. So don't be too helpful. If you don't know, you don't know. The other thing is, man, people get weird about these first party claims. And just so you know what that means, that's like, we're talking about first party claims right now. We're not talking about like a liability claim against somebody else. But I've seen this where people will refuse to cash the check because they think it's like a full and final payment. They're like, I'm not cashing the check because then like I somehow accept that money. And that's not how these first party claims work. If you have a claim against your own homeowner's insurance, it's almost never that way. And the money they give you at first is almost never enough, and they know it. It's just to get you started. So it might just be for, say, known damages, and then other stuff comes out. It might just be this actual cash value payment until you make the repairs, turn in your receipts, and then they're going to give you this RCC or RCV payment. So people don't want to cash the check because they think like that's going to be it. That's not how it works in first party claims. One of the other things is don't compromise the investigation. Remember, I said your insurance adjuster, they're conducting an investigation. And so a lot of people, they will compromise it by trying to minimize the damage, which you do have to do as part of your policy usually. You've got to help minimize the damage. You can't just like watch stuff get destroyed and not help. But, if you are going to make repairs before the insurance adjuster shows up, document the shit out of that. If you have a pinhole leak in your roof, don't replace the entire roof while taking 0 photos and then throwing out all the old damaged materials and then expect to get paid. You have to preserve the evidence so they can look at that stuff later. So that's one thing. Don't compromise that investigation. You gotta give them the evidence to do that investigation so you'll eventually get paid. And the last one for me, I think of is just that, the insurance company they're not your enemy. And I know Chris works for an insurance company, but this isn't like a pro insurance episode or anything. Just remember that this is a contract. It's a contract of adhesion, meaning you purchased a contract. Hold your insurance company to the contract because they're going to hold you to your end of the bargain. So read your contract and there won't be any surprises on what's covered and what isn't. I think a lot of times where you get people just sort of bashing their insurance company is because they just don't know what was in the contract. They had a flood. It says in this section, things we don't cover, floods aren't covered. And then they're mad that the flood isn't covered. Like if you would have read your policy, then there wouldn't be a lot of fighting, right? So I don't know, what is that kind of spot on, and what else should we know, Chris?
I think it is. And specifically when you're talking about not compromising the investigation, you do have a responsibility to minimize that damage.
Right.
But you don't want to rip up the entire roof just because you've got a small leak. And in a lot of cases, if you do find that you have a leak, if you went to the hardware store and got, those 10 by 20 big blue tarps and you weighed them down on top of your roof, just until the insurance adjuster can come by and look at it, keep the receipt because they will pay you for the cost of that mitigation. It's
Right.
mitigating
Except you
further damage.
you should have that tarp in stock already, and you should have the furring strips, and you should have the nails. You should already have that stuff.
Yes, if you are a true to heart prepper, you should probably have some tarps and some bungees and some weights and stuff like that.
Yep.
But the insurance adjuster will notate that and pay you back for it if you have to use it. So that's where you see a whole bunch of blue roofs. It's all the blue and green and yellow tarps
Mm-hmm.
after a hurricane because people in those areas, they understand I have to mitigate this or my insurance company may not cover it at all.
That's right.
But they'll go out and spend $500 on tarps and then that just gets included on their final check. So they're getting reimbursed for it.
Right. So what else should you know besides, I don't know, like the deductibles is a big one for me.
Yes, absolutely. Know what your deductibles are because you may have more than one and they may not be the same amount. For instance, you may have a $2,000 deductible for things like fire, theft, broken pipe, neighbor kid learning how to drive and ends up parking in your living room, but you have a 2% deductible for wind and hail. So on a $300,000 face value policy, that means if you need a new roof from a tornado passing by, you have to come up with $6,000 to repair or replace your roof. So know what your deductibles are. And if you can, dedicate a savings account with that money set aside in it. So most insurance companies, they either give you they'll give you or they'll give the contractor the amount of the damages minus your deductible, and you're responsible for the remainder after that claim disbursement. So you don't have to pay it up front, but having it set aside will prevent you from altering your way of life just to cover the deductible because you already have it squirreled away.
Yeah, that's a good point. And like you said, a percentage deductible like that's kind of like catastrophe insurance. That's like worst case scenario. And I recently, I'll tell you, earthquakes almost always excluded. And I went and purchased earthquake insurance because that really is the one kind of wild card that I can't mitigate. I can mitigate a forest fire. I can't mitigate an earthquake. I don't know when it's going to happen. I think it's probably going to happen. And I want to say it's a lot. It's probably maybe $80 a month and it's a 10% deductible. So you think about that. It could be a huge chunk of money for me, but the peace of mind to pay that $80 a month and then have, maybe tens of thousands, if not hundreds of thousands of dollars worth of coverage if we do have an earthquake. That's just awesome peace of mind. But again, it's a giant. Like I probably am not going, if I have a total loss, I'm not going to have that 10% deductible in the bank. You know what I mean?
And the other good point about that is, let's say you did have an earthquake and the amount of damage doesn't meet your deductible, then that policy is not going to take effect. Same happens if you have a kitchen fire and it only destroys one pan and one cabinet. If you've got a $2,000 deductible, it may not cover it may be less expensive out of pocket to fix the $500 cabinet and replace the $50 pan than your deductible is. So if you don't meet that deductible, the claim will be denied. But it's still important to talk to your claims adjuster because there may be that proximate cause. Hey, the kitchen fire 6 months ago, we didn't realize that it caused a pinhole leak in XYZ drain, and now our dishwasher is, every time it runs, it floods the floor. Proximate cause. So now it's documented, and the total amount of damages will all start to stack up. Now it does meet your deductible. So at least talk to your adjuster and get it on record that something happened because that proximate cause may not happen immediately.
That's actually, you bring up a really good point about knowing your deductible, because let me pitch this scenario at you. You don't know your deductible is, and let's say it's $2,000 and you have $1,000 loss and you go, oh, I'm just going to file a claim. Well, you file that claim, and even though, like you said, it's going to be denied because it's under your deductible, your insurance is still going to go up because you have a claims history. So don't do that stupid thing. Know what your deductible is. Know basically what it's going to cost to fix it and make that decision. Even if you have a $2,000 deductible and you kind of go to Home Depot and you go, you know what, to replace that cabinetry and all this stuff, it's going to cost me $2,200. You don't want to file a claim for that $200, then have a claims history, and then have your insurance premium go up. So I think a lot of people don't know what their deductible is, and they go through the process of filing the claim. It gets denied or they withdraw it, but they still have that claims history sitting there. And even though the insurance company didn't give them any money, their premiums in some cases could still go up, right?
They could. And your claims history, general rule of thumb, a claim on a property claim will follow you for 5 years. So if you file a claim and then you move, and 3 years later, you're trying to get a new insurance policy, when they run your claims history, it follows you because you filed the claim. It also stays on the property. So other people can look into that claims history for the property that you're trying to sell. So just be aware it does fall off. It's not going to hang out forever.
Sure.
You know, if you've got a claim from 7 years ago, that's no longer affecting your rates. And a lot of people think, well, I had a claim 15 years ago and my rates are skyrocketing now. Those two are not related. It's something else that's causing those rates to go up. And I will say across the industry, the price of insurance policies are going up and up and up and up and up. And a lot of that is driven by the inflation and the cost of materials, the cost of labor, skilled labor, especially if you have a brick and mortar home. When's the last time you actually talked to somebody who their profession was a bricklayer?
Oh, yeah. No, a mason is very expensive if you can find one because, yeah, people aren't doing a lot of those trades anymore. You're right.
It is a limited skill. And putting 2x4s together in a pattern like Legos is super easy compared to somebody who's a classically trained mason who does brick and mortar and mixes it all themselves and knows what they're doing. And that mason can probably build anything and is not going to go anywhere. But there's a cost associated with the loss of skill sets across the entire industry.
Yeah, that's exactly right. So to sum all of this up, your insurance policy, it's a tool for your preps. It literally is just like a piece of gear. You need to know what it does and how it works before you use it. Just like a fire starter or a water filter, this is just like training, just like any other training. You need to read your policy and you need to know what it does and how it works for you, just like any other piece of gear, right?
That's a really good way of looking at it. You don't want to be pulling it out of the package and reading the instructions after something happens and it's emergency go time.
Right. Pull it out of the policy or pull it out of the package, see how it works. It's exactly right. Like think about preppers in general. How much gear do I have right now that's just like sitting in the box? Because I'm like, well, when shit goes down, I'm just gonna like learn how to use it. The insurance is no different. And insurance, your policy, it's massive, man. If you're a homeowner, think about that. You don't have a lot of other $100,000 or $200,000 checks sitting in a drawer, probably. But that's what this policy is.
It really is. And I wish I had a $200,000 check in the kitchen drawer that I could just go cash, but nope.
Right. So that's how important this policy is. You have to think of it like that, that it is like a winning lottery ticket. If something happens to your property, you have to know how to use it, when to use it, and what it's worth. So I think that's kind of where I would sum this episode up.
Yeah, you don't want to pull it out of the packaging and find out batteries are not included
Right.
after you need the batteries and you need it right then and there. So look at your policy. It is boring to look through and read through and figure out what's excluded and what's included and things like that. But understand how your policy works. And if you can save your deductible, just squirrel it away, $20 a month, $50 a month, whatever you need to fit your budget until you meet that deductible. And you won't really notice that it's gone, but when you need it, it's there.
Yeah, that's actually a really good point is and then you're earning interest on that deductible that's sitting there in the bank or whatever account you have it in, and when you need it, it's there and you can be made whole again very quickly, right?
Small amount of interest, but
Mhm.
yes,
Yeah.
I wouldn't quite try to live off that interest.
So is my insurance company isn't gonna take my deductible in Bitcoin or something? Is that what you're saying?
In most cases, no, but I can't say exclusively they won't do it because there are companies out there that when you get into some of the higher rated policies or what are called non-admitted carriers, there
Mhm.
are some really crazy rules and things that they'll do to make sure that you have the right amount of coverage.
Oh, yeah, I mean, that's like the Lloyd's of London thing, right? Those, like, named policies where you just say, "This is what I want to insure and how much is it?" Didn't, like, J.Lo insure her butt? Like, you can do stuff like that.
Those types of policies have such strange terms and conditions behind them, but
Yeah,
if something happens, it's there.
right. Yeah, I think that's like a negotiated policy or whatever they call it. Like, they agree to pay you exactly, some amount for one particular peril or all perils or something like that.
Yep. What was it? Zoolander with the hermetically sealed hand model. I'll bet he had
Yes.
a pretty sweet insurance policy on that
Oh,
thing.
yeah, on
But
those hands? Yeah, anyway. Alright.
anything else that you want to know about insurance, AC?
No, man, this was interesting. This is good to do. I think the take home point here is just like any other preps, you've got to cycle this thing out. You've got to pull out the policy, you've got to read it, you've got to see what kind of coverage you have, and you got to cycle that thing out just like your fuel and your food and your water storage. You've got to talk to your agent and say, "Hey, stuff has gotten more expensive. I need to change coverage up a little bit, and this should be just part of your regular preparedness because like you said, this is the ground floor of prepping. This is square one is having your gear insured.
I couldn't say it better myself. So join us next week. Completely different topic that's not going to put you to sleep. I promise. But until then, remember, you are your own stakeholder.